You walk into a bank, you hand over your cash, and you feel secure. You have this image of your money tucked away safely in a vault. But that image? It's a complete illusion. We're about to pull back the curtain on one of the biggest magic tricks in all of finance. We're going to show you why banks don't hold your money, and how that one simple fact is the engine that drives our entire global economy.
All right, let's start with a really simple question. You deposit $1,000. You see the number pop up on your banking app, but where is the actual physical money? Is it in a special drawer, a high-tech vault with your name on it? The answer is not what you think. And honestly, it's a revelation that will completely change the way you look at your bank account from this day forward.
And here's the startling truth. The moment that deposit is made, your money is gone. It's not being stored, it's been absorbed into the system. You see, you haven't placed your wealth into safekeeping. What you've actually done is become a creditor. You've lent your money to a massive financial machine. That balance you see? That's not your money. It's the bank's digital promise to pay you back. It's an IOU.
Welcome to Capital in Context, where we tell the stories behind the world's most important economic and financial moments. Each video explores a moment in time, a market collapse, a policy decision, or a financial innovation, to explain exactly what happened, why it happened, and how it still shapes your world today.
To really get what's going on, we first have to completely dismantle a myth that we all kind of believe in, what I call the warehouse solution. This is that gut feeling, that idea that a bank is just a secure storage facility for cash. You know, like a high-tech locker for your wealth. Just look at the difference here. On the left, you've got the myth. The bank is a warehouse. You pay a fee for storage and you get your exact same bills back. But the reality, on the right, it's the polar opposite. A modern bank isn't a storage unit, it's a financial intermediary. It doesn't charge you for storage, it pays you interest because it's using your money. And legally, you're not a customer storing goods. You're a creditor who has lent the bank your funds.
You know, this whole warehouse model actually has a legal name. It's called bailment. Under a bailment contract, if you drop off a specific bag of gold coins, the bank has to give you back that exact same bag. They can't touch what's inside. But of course, that's not what happens when you deposit cash. You don't get the same $100 bill back. You just get the same value. And that little distinction, it changes everything.
And this is exactly why that old warehouse model just couldn't work today. I mean, imagine it. If all the money in the world was just sitting idle in vaults, the entire economy would just freeze. You'd be paying fees just to keep your money safe. There'd be no interest for savers, no credit for businesses to grow, and no mortgages for families to buy homes. An economy built on idle money is a frozen economy. Simple as that.
So, if a bank isn't a warehouse, then what is it? Well, the real engine of a modern bank is something called maturity transformation. This is the real art of what bankers do. They take your short-term money, your deposits that you can pull out at any second, and they transform it into long-term assets, like a 30-year mortgage. This whole engine of economic growth is built on borrowing short and lending long. And right there in that fundamental mismatch lies the entire system's greatest vulnerability.
And this brings us to the banker's greatest secret, how money is actually created. And I'm not talking about government printing presses. This is a story that started with medieval goldsmiths and today ends with a single keystroke on a computer.
So this whole thing started back in medieval Italy. You had merchants sick of carrying around heavy gold, so they deposited it with goldsmiths. The goldsmiths would issue these little paper receipts in return. Pretty soon, people figured out it was way easier to just trade the paper receipts instead of the actual gold. The receipt became the money. And then the goldsmiths had this aha moment. They realized the actual gold almost never left the vault. So they started lending some of it out, knowing they only needed to keep a small fraction on hand just in case. And in that moment of genius, fractional reserve banking was born.
For decades, every economics textbook told the same story. Banks take in deposits, and then they lend a fraction of that money out. But here's the secret, confirmed in a landmark report by the Bank of England itself. That's not how it works. In fact, it's the complete opposite. Banks don't lend out money that already exists. The very act of lending is what creates brand new money.
Think about it. When you go to get a $500,000 mortgage, the bank doesn't run to its vault to see if other people have deposited enough cash. No, they just check your credit score. And if you're approved, they simply type the numbers into your account. And poof! In that single instant, $500,000 of new money that didn't exist a second ago is created out of thin air. It's what economists call fountain pen money. Wealth created not by a mint, but by the stroke of a banker's pen.
So what really just happened? Well, the bank created two things at the same time. It created a new liability for itself, your new deposit, which is their IOU to you, and it created a new asset,
your mortgage, which is your IOU to them. The whole system is just built on these perfectly balanced, matching promises. And that new digital balance in your account, it's now real money that can be spent out in the world, expanding the total money supply.
Okay, so if banks can create money that easily, what stops them from just creating an infinite amount of it? This question brings us to the inherent fragility of this whole system and the crucial speed limiters designed to keep it from flying completely off the rails.
There are really three main brakes on the system. First, just basic profitability. Banks are a business, right? They can't make endless bad loans that don't get paid back, or they'll destroy their own capital and go bust. Second, there's competition. If one bank starts lending like crazy, its customers will spend that new money, and it'll wind up as deposits in rival banks. That first bank then has to settle its debts, which puts a lid on how much it can overlend. And finally, you've got the ultimate referee, the central bank. It sets the base interest rate for everyone, making it either cheaper or more expensive for all banks to lend. It's the master control for the entire system.
But even with all these limiters, this system has a fatal flaw. Remember that maturity transformation thing, where assets are locked up for decades in mortgages, but liabilities, your deposits, can be demanded back instantly? Well, if trust disappears, if everyone panics and demands their cash all at once, the bank physically does not have it. That is a bank run. It's the moment the warehouse illusion completely shatters and the whole system collapses under its own weight.
To stop this nightmare scenario, governments have installed a couple of safety valves. You've got deposit insurance, which guarantees your money up to a certain amount, so you don't have a reason to panic and run. Then you have the central bank acting as a lender of last resort, ready to pump in emergency cash. But, and this is a huge but, these safety nets create something called moral hazard. If banks know they're going to get bailed out, they actually have an incentive to take on bigger, crazier risks to chase higher profits, because they know the taxpayer is their ultimate backstop.
So what does this all mean? When you finally pull back the curtain and see all the moving parts, you realize the entire system isn't built on gold bars or concrete vaults. It's built on something much more powerful and much more fragile. It's an architecture of belief.
The ultimate insight is this. Money isn't really a thing. It's a shared idea. It's a social convention. Whether we're talking about a silver coin or just a digital number on a screen, its value comes from only one place: our collective confidence that we can exchange it for real goods and services. The invisible glue holding the entire global economy together is just trust. And here's why this matters to you. Here's the practical takeaway. When you leave a big pile of cash just sitting in a low-interest checking account, you are, in effect, giving the bank a zero-interest loan. They get to take your capital, use it to create new loans, and generate huge profits for themselves, all while the value of your dead money is slowly but surely being eaten away by the very inflation that this system helps to create.
So the final and most crucial question is this. Now that you understand how the game really works, is your money working for you, or is it just raw material for the bank? Understanding that a bank isn't a warehouse, but an engine, is the critical first step. The next step is deciding how you're going to put your own capital to work.
Thanks for watching. If you found this video interesting, hit subscribe to Capital in Context. Remember, it's not chaos, it's design. You were just never meant to see it.